Is the stock market about to crash? Well, in this video, you guys are going to find out. I'm going to dive into what's been happening in China with the Evergrande crisis and whether this will affect us over in the West and potentially ripple throughout the entire stock market. And then I'm also going to dive into a few indicators of whether the stock market is currently overvalued right now. So this is going to be a really interesting video, guys. Let's not waste any time and let's dive in. So one of China's biggest property developers is in trouble, and the company's called Evergrande, and their stock has actually plummeted by over 80%. So Evergrande is saddled with $300 billion in debt and struggled to make payments, and the creditors are coming round circling like vultures. Now, this is being compared a lot to Lehman Brothers and the collapse of Lehman Brothers, which happened in 2007, 2008, and subsequently caused the major financial crisis. And this is why there's a lot of worry in the market right now, because people are seeing this issue with this major property developer in China, Evergrande, and they're drawing synergies between Evergrande and Lehman Brothers. Are those synergies justified? Well, I'm going to explain a little bit more about that later in this video. So Lehman Brothers actually filed for bankruptcy with $619 billion in debt, and whose collapse was the tipping point of the 2008 global financial crisis.
I want to short the housing market.
Now, the first major note, I do need to state the difference between Evergrande and Lehman Brothers, just to calm everyone down and everyone can just relax, is Lehman Brothers actually held financial assets, which were a collection of mortgage-backed securities, which were basically really bad mortgages given to people on what's called ninja loans, no income, no job loans, and that was what Lehman Brothers collapsed on. However, Evergrande actually owns real land in China, so I do believe Evergrande is a little bit more secure than Lehman Brothers was. Now, Evergrande is one of the 3 largest property developers in China. According to its website, it owns over 1,300 projects and more than 280 cities. And I have done a little bit of research. Real estate in China makes up around 25% of the Chinese economy, so it is a major deal, and a real ripple in this economy can affect the rest of China. Now, for years, Evergrande has been pursuing a high-growth strategy of piling on massive debts to build property for China's urbanizing middle classes. Now, its strategy worked because China's population was growing massively, so Evergrande's share price soared by 410% between 2017 and 2020. And Evergrande even built a soccer stadium and developed a national team to fill that stadium. However, during all these good times, Evergrande was building up a massive amount of debt of over $300 billion. As you can see from this chart right here, Evergrande's debt has steadily increased over time, and that is really can be a worrying sign to see if things change in the market. Now, ratings agencies such as Fitch have downgraded their debt earlier this month, saying a default was probable bankruptcy. Markets are pricing in this default. So Evergrande's bonds are trading around 30 cents to the dollar, and the share price has fallen 48% in September. And Chinese regulators have even reported recently to major banks in China that Evergrande will not be making upcoming loan payments. Now, the doomsday scenario. This is another Lehman Brothers tipping point which causes a financial crisis in China and then spreads throughout the US. Now, the good news is I did see a quote from the Bank of America, and they stated they have minimal exposure to China and the Chinese market, and thus it will stop at the US borders. But we have seen this before with another contagious crisis which started in China and then spread throughout the world. So the Chinese government does have an immense amount of power to control any issues in terms of stopping any potential financial crisis and ripples throughout the economy. So it looks like there is a good side to all those human rights violations. Now, that's a really out of taste joke, but here's one more piece of good news. So Evergrande has actually managed to get a debt deal. So the main property unit of Chinese real estate giant Evergrande said it has struck a deal over a bond interest payment which is due on Thursday. So the amount due for the domestic bond is estimated to be $35 million, and the announcement that this will offer some relief to investors concerned over the company's debt crisis. Okay, so the best case scenario is this is an isolated incident. It affects Evergrande. Let's say they're bailed out by the Chinese government and everything's fine. The middle case scenario is this ripples throughout China, affects the growth of the Chinese economy, and maybe causes a slowdown in certain sectors such as mining, construction, and real estate. The worst case scenario is this ripples throughout the world and causes a major financial crisis, which, fingers crossed, doesn't seem likely to happen. So I wouldn't be panicking and selling my stocks at this point. And to be fair, even if this was the tipping point, let's say, for a crisis, it's probably still best not to sell your stocks. It's probably best to wait for a crash to come and then actually buy in. Be greedy when others are fearful. So is the stock market overvalued over in the US right now? Well, we're going to hop into two big metrics. The first metric is what's called the Buffett indicator, which basically takes the GDP, the gross domestic product, the output of the US economy, and divides us by the market value of all the stocks on the stock exchange. And this is a real simple method Warren Buffett likes to use to give a quick indication of how much the stock market is overvalued. And according to the Buffett indicator, the aggregate US market value is 54.9 trillion, and the annualized GDP is 22.9 trillion. So the Buffett indicator states that it's at 239%. That's currently 91%, or 3 standard deviations above the historic average, suggesting that the market is strongly overvalued. However, guys, do be aware the stock market is forward looking. So this annualized GDP will not be taking into account, let's say, the boom in travel, which is subsequently coming, the boom in hospitality, which is increasing over time. All these areas will actually increase the GDP in the future, but it is still an indication we need to watch. Now, the second indicator we're going to dive into, and this is one I do really like, and that's the Shiller PE ratio, the Shiller price to earnings ratio, and this is cyclically adjusted. And this basically outlines how much investors are willing to pay for, let's say, $1 of a company's earnings. So, for example, the PE ratio right now is 37.6 on average. And to me, that's pretty high right now. The max it's ever been, and this is the real big warning sign, is around 44, and that happened during the dot-com bubble and then subsequent crash of the year 2000. Apart from that dot-com bubble, this is the highest it's ever been. But before you guys run off and go sell all your stocks, let me just put things into context for you. So if we zoom out a little bit, so interest rates are actually really low right now. So if I look at the 10-year T-bond rate, for example, that's at just 1.33%, which is extremely low. Now, to me, that says that investors don't really have much options in terms of investing. It's basically the only game in town is to put your money in the stock market. You're not going to put it into a 10-year bond and earn 1.33%, or a savings account and earn 0.001%. You're going to put your money into the stock market. So this is an indication, I believe, why the stock market is shown to be overvalued right now. Is the stock market cheap? No, of course not. Is it overvalued? Yes, of course it is. Can there still be opportunities found in different parts of the market, in individual stocks, in inefficiencies in the pricing of those individual stocks? Yes, and there always can be found those opportunities, whether the market is overvalued, undervalued, or whatever the market is. But I personally wouldn't be buying the entire market right now. Potentially, you can still dollar cost average in if that's what you do and if that's what you've set up previously. But personally, I wouldn't be buying the entire market, but I'd look for those individual opportunities, those gems where you can actually make great returns. And with regards to the whole Evergrande crisis in China, I would basically watch that very closely, see what happens with that. But personally, I wouldn't worry too much about it, and hopefully it will all stay in China and just be an isolated incident. With that being said, if you guys found some value in this video, feel free to give it a big thumbs up. It helps out tremendously with the channel. If you haven't subscribed, feel free by hitting that subscribe button, turning that notification bell on. If you want to join our VIP membership group and get live updates exactly when I'm buying, selling, and access my entire portfolio, check out that second link in the description below, or the first link to learn how to be a great fundamental investor. With that being said, thank you guys so much for watching. Hope you all have an incredible day, and I'll see you in my next video. Invest safe.